Selling homes smarter, faster, and for more.
Welcome to the Bay Area Real Estate Show, the one and only show in the Bay Area where we dive deep into the real estate market. I'm your host Annaiah, and today I am joined by the fantastic Apryll Held, our resident mortgage expert. We are here to talk all things Bay Area real estate, from market trends and hot neighborhoods to financing your dream home. Got questions? We want to hear from you. Give us a call on our studio line at 408 912 5038. Hi, April. Welcome to the show.
Hi, thank you so much, Nagaraj.
Listeners, if you have any question this on the Bay Area real estate, this is the time to call for. Our studio line numbers of 408 912 5038, and all our recordings will be uploaded on our YouTube channel, and you can say hi to our lazy assistant too in the show later. So April, my first question is, how is the rates? Like, is the rates going to be down? Are you seeing some downtrend, or how is it?
Yes, we actually have been seeing a nice downtrend, which we've been really hoping for. Probably we're back in the range of where we were approximately 2 months ago. We had a little bit of an increase, and that we've had about a week's worth of nice settling down to a lower rates.
So, listeners, if you're planning to buy a house and if you have any mortgage questions or anything on a Bay Area real estate, right, you can give us a call. Our studio line numbers are 408 912 5038. We are live on a Bali 92.3, and I'm talking to myself, Nagaraj, and we are talking to Apryll Held, and we are talking about a lot of Bay Area real estate scenarios and the mortgage related stuff. And if you want to buy a house and you don't know what is the down payment is needed, or like if you have any burning questions on the mortgages, you can give us a call. And it's a good news, as April said, we are seeing a downtrend on the rates. If you would like to know what is the rates, you can give us a call too. So our studio line numbers are 408 912 5038. April, one question is like follow up is, while a Fed rate cut could theoretically lower mortgage rates and stimulate a demand, right? But do you think this will somehow, the rates dropping down, you're seeing the market trending going towards the other side? Like, do you think the Bay Area market home starts going down?
As far as as far as home values,
Home values?
I don't see that happening because the supply is so low that everybody's still trying to get in a home, and there aren't that many homes on the market compared to the demand. So I don't see the values going down.
Because a lot of folks might be waiting to rates to go down, and then there's a time to jump in. Okay. But in the Bay Area, right, we have one caller. Let's take it up. Welcome to the Real Estate Show. Myself, Nagaraj. Annaiah. Name, please.
Yeah, hi, my name is Kishore.
Hi, Kishore. Welcome to the show. Do you have any questions for us, Kishore?
Yeah, I just want to check what is the current rates for any investment property?
Okay, that's a great question. So investment, there are two ways to do it. I think I will allow April to answer it, then I can follow up on that.
Sure. So typically, investment properties, because of the risk, they are about 0.5%, sometimes 0.75%, but most of my pricing is about 0.5% over a owner occupied. So you're probably looking, depending on whether it's an ARM to a fixed rate, somewhere between about 6.875% up to about 7.375% for a 30-year fix. So it just depends on the product that you're looking for.
So is it how much down, April? How much down is needed for the investment properties?
So we can do as little as 20% down on the investment properties. A lot of times the pricing with a lot of lenders will be much better, but you have to put down 25%. The rates usually at 20% for us are the same as 25%. So you'll get the better rate either way.
So the ARM rates are 6.875 to a 7.375, again, depending on the credit score and a lot of scenarios, right? And the minimum down payment is a 20% down is needed.
That's correct.
And it's a 5-year ARM or it's a 7-year ARM?
So the 5.5 ARM fixed for 5 years and then adjusts every 5 years. That would be at 6.875%. And if they wanted a 30-year fix, then you'd be looking at somewhere around 7.375.
Okay, let's go back to the primary resident. How is the rates for the primary residents?
They're doing really well. We're actually seeing them dip down under 7%, which is a welcome surprise, about 6.875% for a 30-year fixed.
Uh-huh.
And then if you want the ARM loan, you're looking at about 6.375% for a 5.5 ARM.
I think it's not too bad. I think it's just a 0.5%. I think for the Kishore, the one more better way to consider, right? Instead of doing an investment properties, you can think about buying as a secondary home also. I think that is a great interest rate. I think interest rates will be closer to the primary residence, right, April?
Yeah, you know what? We still price the second homes as a primary residence, owner occupied. When you go into normal lending guidelines, some of the investors, I would say most of the investors now look at that as being risky and may have a higher rate associated with it. It just depends on the investor, but we do the same rate if it's as a second home. But you have to qualify, if it's a second home, you have to qualify.
Give the justification.
Yes.
Give the justification why you need a second home and where
Yes.
you are buying it. Are you buying it like basically for your vacation or your short-term rentals? You need to give the justifications. So Kishore, I think there are two things you should need to consider. One is you can consider as a secondary home or you can consider as an investment properties. Secondary home is like basically you can get it for 6.375 with a 20% down. And if it is an investment properties, then you're going from 6.875 to 7.3. I think it's a good rate for 20% down.
Yeah, that is correct. And also when you're doing a secondary home, obviously it has to make sense that it is someplace that would be your second home, maybe in a resort location. Maybe it's somewhere that a family member lives or something like that you're going to be visiting. So in order for it to be a second home, it needs to document that it makes sense that it's actually a secondary residence that you're going to.
I think we just closed one loan 1 month back. I think we closed it for one of my clients. They bought it in the River Island. They bought it for the vacation, like they bought it next to the riverfront home. And so you can do the creative ways on the financing stuff, but you need to talk to the lender, explain on your scenarios, and we should be able to help you out. Kishore, any follow-up question, Kishore?
No. Thank you. So how do I contact you?
You can call me at 858-880-4577 or go to nagarajhomes.com and I can give the April's number at the end of the show.
Okay. Thank you.
Thank you so much, Kishore, and best of luck for your real estate journey.
For calling.
Yeah. Listeners, you're listening to a real estate show. Myself, Nagaraj Annaiah, the Bay Area one and only realtor. I'm talking to Apryll Held, and we are talking about a lot of mortgage options and real estate. So we would, if you have any questions like Kishore, you can give us a call. Our studio line numbers are 408-912-5038. And don't be shy. Any small questions. Also, you're doing a community service or you're basically educating yourself also. So you can give us a call. Our studio line numbers are 408-912-5038. I think we were discussing before Kishore, right? We were discussing about the various factors why the Fed rates might not impact the Bay Area real estate. One, as you said, high demand and supply, low supply. Second thing is strong job market and high incomes. Okay, you're seeing at one time there's a lot of chop-offs happening, but still there is people who are sitting at a high incomes, correct? And the third thing is the cash buyers. Bay Area especially, right? Lot of wealthy individuals from the outside institutions come and purchase it here. And one more thing is psychological factors, correct? Bay Area is often driven by like fear of missing out, April. Okay. A lot of if you can see that even in 2 years, 3 years, they came into Bay Area, they keep seeing that, hey, it's a wonderful place to live in. Okay. You go to Texas, you get a bungalows or mansion, 4,000 square footage or 8,000 square footage. How much is a livable space? How much space you can live in there? Right? You can't occupy even 8,000. I feel even a 5,000 square footage in Texas, Austin area is equivalent to 2,000 square footage in the Bay Area. Do you agree for that or do you have something else, April?
I totally agree.
Listeners, if you don't agree or if you agree, you can give us a call. We are comparing to a Texas homes to a Bay Area homes. And if you want to debate on that, or if you have anything on the real the mortgage or a real estate, this is a time to share for. Our studio line numbers of 408-912-5038. I think that's especially the psychological factors also makes a difference in the Bay Area real estate. All this, even the rates going down, we don't expect home prices to go down. So coming to my second question, or like our discussion, right? What are the alternative or the creative ways to keep our mortgage rates low?
Definitely a adjustable rate mortgage, which can make sense in quite a few different scenarios. If you do an adjustable rate mortgage fixed for 5, 7, or 10 years, you're going to get a much lower interest rate than if you do a 30-year fixed mortgage.
Mhm.
And there's quite a few factors and reasons why that might be the best alternative for
Mhm.
you. One, if we forecast rates are going to be going down in the future, maybe you're not going to be holding on to that loan for a long time. So that would be one reason. Or
Mhm.
maybe, you're going to buy a starter home and you're only going to live in that home for a certain period of time. Then, you're going to purchase another home later. So there's a lot of factors why that might make the most sense for you.
So the most creative way is get it for arm rates. Don't go for 30 years fixed, right? Arm rates makes a difference. Arms is like, I think a lot of listeners, there might be new buyers out there, or first time they're listening on to it. I think we need to explain what is arm also. This is not our arm, okay? It's arm adjustable rate mortgage. So it's basically they are pre-fixed for 5 years, 3 years, or a 7 years, or a 10 years fixed, right? It's a still 30 years loan program.
It's amortized over a 30-year program, but fixed for either 3, 5, 7, or 10 years.
This is the one of the creative way they basically they came up so that they can reduce the rates, because 30 years, as April said, it was close to 6.875 or 7% for 30-year fixed. Okay, instead of that, go for a 5-year fixed. It's still a 30-year loan program where the rates are 6.375. That's a one way to do it. And the second thing is, instead of waiting for 20% down, you can get started with even with a 10% down.
That is correct.
Okay, so that depending on the lenders, some lenders can do complete 9%, 90% as a one single loan, or they'll be breaking down into two different loans. One's a 10% interest only, and the another is a 80%. That is also is a one way to do it, because you keep on waiting, accumulating for a down payment. The home prices are going up. What are the home prices you saw last year? The home prices are not the same. And one more thing, very important in the Bay Area real estate, a lot of buyers will be sitting on the stocks. Okay, they are always confused. Should I sell my stocks and buy a house, or should I keep on waiting for the stocks to go up? But they don't realize if they're doing a short-term sales, they're going to pay higher interest rates. So instead of paying for a short-term sales rates, how about they go for 15% or a 10% down? Wait for some one more year until it becomes a long-term stocks. That's one of the best option, right, April?
I agree. And there's a lot of people that don't want the tax consequences of a certain in a certain year. So, they can put the 10% down and then later on pay off the 10% again once they decide they want to sell those in the future if they want to, and then part of that payment goes away.
Yeah. Listeners, you're listening to Real Estate Show from Nagaraj and Annaiah. I'm talking to April L on the various mortgage options. What are the creative ways so that you can keep your rates down, or like how do you buy a home? Correct. So if you have anything to share, or if you have any questions, and you're planning to buy an investment, so how do you go for an investment? You're like basically, if you are, do you want to wait for collecting the money to get an investment property, or is there in a way you can get an investment property? That also we're going to talk about. If you have any questions, you can give us a call. Our studio line numbers of 408-912-5038. April, one more thing is a HELOC. A lot of people might be not knowing what is a HELOC. How is it so creative way of that this loan, especially when you want to buy an investment property? For example, the Kishore had called us. If the Kishore has just 10% down now, if he wants to buy an investment property, should he wait for another 10% to accumulate, or he can borrow it from a HELOC?
So in certain cases, yeah, we can do a 10% HELOC with the 10% down on an investment property or on a primary residence.
Mhm.
So, and what how we structure it is by doing a home equity line of credit versus doing a one loan that may have mortgage insurance. So it's a very flexible way. A home equity line of credit basically is a line of credit in which you only pay for the outstanding balance that you've drawn upon. So if you pay that down and take money out of stocks and you decide, you know what, I want to pay that down, that payment will completely go away if you pay it down to a zero balance. So it's very flexible.
I think there's a lot to discuss on that part. See, there's a lot of people, right? Home equity line is like you borrow it from a primary residence. It can be your secondary loan. Correct. It's home equity line is always your secondary loan. It can't be your third loan on the home. Correct.
Correct.
So secondary loan, it can be only as a secondary loan, because if you already have one mortgage, you can buy as a second mortgage, but not a third mortgage on the house. It can be on your primary residence. It can be on your investment property. But only thing is you need to say how much the property is appreciated and how much is your pending balance.
That is correct. The good thing about it too is you also, even if you have the line, you have it, completely at its max line amount, you can pay that down, but then it's going to stay there also for a time period. So if you ever want to utilize it over, say, 10 years during the draw period, you can borrow against it, pay it off, similar to revolving credit or a credit card, but it's the lien on your house. And so if you have cash flow that you want to do or make improvements or anything, you can charge it up and pay it back down, and you only pay on the existing balance.
Yeah. The reason I was asking about the HELOC, right? Like one of my client 3 years back, okay, he did the home renovation. He paid $5,000 to do a tree, to basically got a grown tree of like 13 years tree. We got it. And he put it in a backyard. To pay a 5,000, he sold his NVIDIA stock.
Oh.
It was a $5,000. Now the same value of this tree is how much is it?
Oh my gosh.
So, listeners, when you have anything like this kind of scenarios to do work for it, right? Like always talk to the expert, understand what is the better fit for you, because especially the investing on your house, right? It can be kind of always a challenging. So talking to the experts makes a difference. And if you have any questions and if you want to share your tree story also, you can call us. Our studio line numbers are 408-912-5038. So the story is how $5,000 become 50,000 in 3 years.
Yes.
So what are some of the biggest mistakes you see with the buyers when it comes to financing their homes? That was one of the biggest mistake. That's the free example, which I told you. So what else do you think the biggest mistakes a lot of buyers you see? Common mistakes are the biggest mistakes.
I would say a few of those might be they think they have to put down too much money at the beginning, where the opportunity cost of that money, if they didn't put that down, might be making more than the actual interest rate that they're paying. So that's probably one of the big mistakes.
One more big mistake is not getting pre-approved. Correct. And see, if you don't get your pre-approved, and if you don't basically talk to, in my case, I do a lot of pre-approval to my clients without even going to the actual lenders, because I know the markets, basically the client scenarios, talk to them, understand. So based on these scenarios, we can do it. And basically, or talking to the loan officers or the mortgage experts, get pre-approval and tell them clearly. It's especially like a lot of clients, they ask me, should I pull the hard pull or a soft pull credit scores? Can you get me a pre-approval without doing any credit score check? Is it possible, April? Do you think that is one of the dumbest mistakes they make, right?
You know, it's interesting because actually we just started more often sometimes doing soft pulls of the credit. So I can do a pre-approval based on a soft pull. A hard pull always needs to be done once you do the loan, but sometimes that can be an issue if other people do hard pulls and we pull a soft pull, then later on we need to do the hard pull. If for some reason time has passed and once we do their hard pull, suddenly they have a lot of inquiries that could affect their credit score negatively, but we can do the soft pull. So for people, if they prefer that, we can certainly do that for them.
Listeners, you are listening to Real Estate Show from Nagaraj and Annaiah. I'm talking to Apryll Held, the mortgage expert, and myself, a Bay Area real estate. So we're discussing about a lot of financing options. So if you have any questions, do give us a call. Our studio line numbers are 408-912-5038. So can we do a pre-approval without even pulling the score? Do you think it's the dumbest thing to do without pre-approval, without even pulling the score? Can we make a pre-approval based on the FICO score?
So the one that I pull, I prefer to pull a tri-merge. Some just do one bureau on a soft pull. I think a tri-merge with all three credit bureaus because I want to see what they really have. They could have one really good score and one really bad score, and you don't know. And so I think it's really a good idea to get the full credit picture. So we can do a soft pull, but it's with all three bureaus, I think is prudent.
Okay. So the next follow-up is like, what kind of the credit score and the down payment should buyers aim for in the market? I think we discussed about minimum is a 5% if it's a 1.05 million purchase or 1.08 purchase in Santa Clara counties. And Alameda, I think also the same thing up to 1.08. But what kind of credit score you can basically help my clients? What's the minimum credit scores do you need?
Oh, what? We have credit scores and programs. They might have different rates associated, but I have credit scores that can go down 620 and some even below, depending on what the loan amount is. Some even in the 500s. Those will have certain loan amount maxes on them, but we do have things for bruised credit. Of course, if you have that, sometimes your credit score is going to be your rate's going to be a little bit higher.
Yeah, but listeners, whenever somebody asks you to apply for a credit card, right, be careful because if you miss any one of your credit payments and if it goes to the collections, your credit score will be impacted very badly. I think we had helped one of the client recently where the husband's credit score was so bad because they had borrowed it from Thanksgiving Day, I think, right? Like they were getting free offers and everything, 10%, 15%. They borrowed it and they forgot to pay for the credit cards. So be careful if somebody is offering you free credit cards or with some points. If you buy it also, or if you get the credit cards also, make a note when are the payments due and how much is it due.
I would go even further to say don't do store credit cards because those limits are very low. And then when you max them out and charge, it's going to lower your credit score also, even if you pay it off in full and on time. So that 10% savings on whatever it is you're buying might be more costly later on down the line.
Yeah, that's a watch out. I think 1 or 2 credit cards might be a better instead of having a 20 credit cards and you'll be checking your wallet, which credit card to pay for it. Okay, listeners, thank you so much for listening today, and thank you, Apryll. And we know that there's a lot of volatility in interest rates, right? And especially talking to the experts like you or me before buying a house or refinancing or selling a house is very important. If somebody wants to talk to you, what's the best number to connect with you, Apryll?
Best number to call me is 949-306-8100.
Okay, listeners, all these recordings will be uploaded in my Nagaraj Annaiah's channel. And thank you so much for the show. And like, if you have any questions, you can always reach out to me at nagarajhomes.com. Click on a WhatsApp icon and easy to connect. And have a wonderful evening. Thank you.
Have a good night.
Promote your business.